I'm John Lesky, recently retired personal financial advisor and founder of FinHealth, a tool to guide you to your financial independence. FinHealth is a lifetime approach to personal financial planning. It encourages you to examine how to purposely apply your actual and expected financial resources to give you the best chance of living the life you want. A key element is for you to take a long-term approach to investment, accumulating investment wealth over time in a disciplined, strategic way. It encourages you to shut out the inevitable short-term noise of markets and implement a predetermined investment strategy no matter what investment markets are doing. Not only is such an approach good for your sanity, it gives you the best chance of earning the long-term returns that investment markets have historically provided and, on the assumption that capitalism continues, are expected to provide in the future. And these returns are potentially a very significant part of investment wealth accumulation for the long-term, patient investor. This video demonstrates how regular long-term investment, commenced as early as possible, can take advantage of what's often called the magic of compounding. It can dramatically reduce the amount actually needed to be saved for financial independence and/or retirement. First, as a benchmark, we will examine what a 30-year-old investing $50,000 a year in inflation-adjusted terms can expect to accumulate over an expected 40-year working life, that is, to age 70. The total investment amount is $2 million, that is, $50,000 times 40 years. The assumed annual return is 3.5% a year after inflation and tax. This is the return projected for a 40% defensive, 60% growth portfolio in the FinHealth personal finance software. It's not unreasonable based on historical long-term investment returns. It's also assumed that the annual investment returns achieved on the accumulating balance are the same each year, that is 3.5%. In reality, returns may fluctuate considerably, and the timing and order of returns will affect the final investment balance accumulated. The chart on the screen now shows how the investor's investment wealth accumulates over 40 years, based on the assumptions. The total $2 million investment grows to $4.23 million, meaning returns account for $2.23 million of the final investment balance. Investment markets have done more than 50% of the work. But what happens if the investor invests the same $2 million, but for a shorter period? The table shown examines how much needs to be invested each year for the provided investment starting dates. So, for an investment start date at age 40 rather than age 30, the investor must invest $66,667 a year for the next 30 years to invest a total of $2 million, $100,000 a year at age 50 for 20 years, and $200,000 a year at age 60 for 10 years. The next chart compares the accumulation experience for each of the investment start dates. The table now shown compares the final investment balances for each investment start age. Clearly, your final investment balance is highly dependent on when you start to invest. The differences in the final balances are huge, yet the amount of investment is the same. The next chart highlights that it is investment return rather than amount invested that is responsible for the differences. For each investment start date, the total amount invested is the same, but investment return for the start at 30 scenario is $2.23 million compared with $0.35 million for start at 60. The next chart shows the same information but looks at the percentage of the final investment balance that comprises amount invested and return. The message should be very clear. If you want to achieve financial independence with the least effort in terms of amount required to be saved, you need to start letting investment markets work for you as early as possible. Unfortunately, for most, this is easier said than done. Many start investing seriously when it's too late, unable or unwilling to sacrifice spending now to invest for considerable potential benefits down the track. And the longer the deferral of implementing a regular investment strategy, the greater the amount that must be saved to accumulate a given amount of wealth. The table on the screen now shows the annual amount that must be invested for each investment start age to accumulate the $4.23 million final investment balance achieved for the start at age 30 scenario. Deferring investment to age 50 and 60 requires an exponentially large change in savings habits. Annual investment amounts are 299% and 721% respectively larger than the start at 30 requirement. For most people, such changes are unrealistic and they either need to work longer and/or reduce their retirement expectations. It's also important to understand that higher investment risk and potentially higher investment returns aren't likely to be able to offset the increased savings and investment required to compensate for the failure to invest early. This chart shows how the final investment balance varies with changes in return assumptions for the start at 60 investment scenario and a total investment amount of $2 million. That is $200,000 a year. Even opting for a 100% growth portfolio, assumed to have a 5.5% a year after inflation and after tax return in the FinHealth personal finance software, results in only about a $211,000 increase in the final investment balance compared with the 3.5% a year more balanced portfolio. The final balance of $2.575 million is still well short of the $4.23 million final balance for the start at 30 scenario. And the higher risk portfolio may be well outside that which is consistent with the investor's attitude to risk, posing the likelihood that the investor will abandon the investment strategy should markets perform poorly for an extended period. So, some simple financial mathematics suggests a few unavoidable realities of investment and financial planning. 1. The earlier you start a regular investment program, the less you are likely to need to save to achieve your version of financial independence. Investment markets can be expected to do much of the wealth accumulation work for you. 2. The longer you defer putting in place a regular investment program, the more you are likely to need to save to achieve your version of financial independence. There may not be sufficient time for the magic of compounding to be revealed. Hopefully, you found this video of interest. I'd like to know what you think. Please provide any comments or questions below. And finally, thanks for watching.